back to Iron Financial. You know, this is the one channel out there that's dedicated, truly dedicated to forging stronger portfolios and stress testing the market's weakest links. We don't play around with hype here, we deal in the hard facts, the fundamentals. And today, we are putting a fintech giant right under the microscope, Webull. The ticker symbol is bull, which is kind of fitting, but the real question we're asking is whether this bull actually has the legs to run or if it's about to stumble right off a cliff. The headlines, well, they're screaming gross, but the stock chart, it's telling a very different and, frankly, a very painful story. So we're here to cut through all that noise and give you the unvarnished truth. All right, let's just get right into it. The numbers that are coming out of this company are, well, on the surface, they're absolutely staggering. We're talking about record revenues, we're talking about assets under management just exploding, and a user base that would make most of their competitors just green with envy. It really seems like they are firing on all cylinders when you look at that top-line growth. It looks like the perfect fintech disruptor story. But hold on a second, let's just pump the brakes here. If everything is so perfect, then why is the stock down over 48% in just the last year? The market clearly isn't buying this story. You know, record revenue is fantastic for a press release, but it doesn't mean a single thing if the structure underneath it all is rotten. So what are we missing here? What does the market see that the headlines don't? That is the real question we need to get to the bottom of today. Is this one of those generational buying opportunities, or is it just a really well-marketed value trap? Exactly. And to get to that answer, we need a solid battle plan. So here's how we're going to break this all down for you. First, we'll lay out the battlefield in what we're calling the Webull war zone. You know, that big conflict between the amazing numbers and that terrible stock price. Then I'm going to forge the bull case, piece by piece, using the company's own record-breaking data. And then once that shiny case is all built up, I'm coming in to find the cracks in the armor. We're going to look at profitability, we're going to look at valuation, and we're going to look at some really serious red flags that are buried deep in the financial statements. And after that, we'll debate the AI wildcard. Is it a game changer, or is it just more expensive hype? And finally, we'll bring it all together for the final verdict. So let's get to work. Okay, let's dive right into this. The Webull war zone. So on one side, you've got the company's narrative, right? They position themselves as this premier platform for sophisticated, active investors. You read their press releases, and it's just a highlight reel of global expansion, new product launches, and millions upon millions of new users. And then on the other side, you have the stark, cold reality of that stock chart, a brutal 48.3% one-year loss. Look, that's not just a pullback, that is a beatdown. This massive disconnect is the entire reason we're doing this deep dive. The market is pricing in a significant amount of risk here, and our job today is to identify exactly where that risk is coming from. All right, let's build this thing from the ground up. Before we even start talking about any of the risks, we have to acknowledge the sheer, raw power of this company's growth engine. I'm going to lay out the bull case for you, using nothing but the hard data from their latest reports, no narrative, no spin, just the cold, hard numbers. We need to understand the machine before we can start looking for any faults. This is the story that has attracted all the bulls and captured the market's attention, and you just can't deny it is impressive.
Pillar number 1, revenue. Let's start there. For the full year 2025, Webull pulled in $571 million. Now, that is a 46% increase year over year. You have to understand, in this economic environment, a 46% growth rate for a company of this size is nothing short of explosive. We're not talking about some small startup that's just finding its footing. This is a major player putting up massive growth numbers on what's already a substantial base. This is the kind of top-line performance that really gets growth investors to sit up and pay very close attention. It's the absolute foundation of the entire bull thesis.
And here's the thing, this growth isn't slowing down. In fact, it seems to be accelerating. If you look at the fourth quarter alone, they pulled in $165.2 million. That's a 50% jump from the same quarter last year. Now, what's crucial here is that this wasn't just in line with expectations. It absolutely smashed them. The street was looking for something around $160 million. This kind of beat demonstrates some powerful momentum as we head into the new year. Now, here's what's really, really interesting about this. It's not just some kind of ephemeral revenue that disappears. It's actually backed by a massive influx of real capital. Customer assets on the platform just hit an all-time high of $24.6 billion. That represents an 81% year-over-year growth. So this isn't just about getting people to trade more. It's about getting them to trust Webull with a larger and larger share of their entire portfolio. An 81% increase in assets under management is a massive vote of confidence from their users, and it's a huge leading indicator for future revenue potential. You know, more assets means more interest income and a larger base for all that trading-related revenue. So you might be asking, where is all of this coming from? Well, take a look at the foundation of this entire operation, the user base. They now have 5 million funded accounts, which is up a respectable 8% year over year. But the crucial point here is the pipeline. They have a staggering 26.8 million registered users. That is an enormous pool of potential customers who are already on the platform, they're using the tools, and they're just one small step away from actually funding an account. That 26.8 million figure is a massive untapped reservoir for future growth. It gives them a huge addressable market right within their own ecosystem. And this company is not just sitting still, not by a long shot. They are on a global conquest. They've launched in the European Union, they've relaunched crypto trading right here in the US and expanded it in Australia. They're even moving beyond equities now and getting into corporate bonds. And critically, they're forging these strategic partnerships, like the one with Meritz Financial over in South Korea. This isn't just a US trading app anymore. They're building the foundations of a global financial empire. And every single new market is just another layer on top of their growth engine. So to wrap up the bull case, I'll just use the words of their own US CEO, Anthony Denier. This is a focused, mission-driven company. They know exactly who their customer is, that sophisticated, active, self-directed investor. And every single move they make is designed to serve that customer better. The record revenue, the soaring user base, the global expansion, it all points to a company that is executing its plan with absolute precision. That is the bull case, an absolute titan of growth. Now, let's see if it can withstand a real stress test. An impressive structure, I'll give you that. The facade is certainly gleaming. But, a skyscraper with a weak foundation is really just a disaster waiting to happen. All that top-line growth is completely worthless if it doesn't translate into actual shareholder value. So I think it's time to stop admiring the architecture and start running some diagnostics on the actual concrete and rebar holding this entire thing up. Let's see if we can find some cracks in the armor. And wouldn't you know it, we find the first major crack immediately. Let's just go back to that fourth quarter report for a second. As the analyst pointed out, yeah, revenue was fantastic, a solid beat. But now look at the other side of the ledger, earnings per share. They reported 1 cent, a single penny. The street was expecting 4 cents. Look, that's not a small miss. That is a massive 66.7% miss on profitability. So the crucial point is this. While they are incredibly good at generating sales, they are failing and failing badly to translate that success to the bottom line. And why? Well, the report tells us total operating expenses are up 55% year over year. They are spending an absolute fortune to acquire this growth, and it's completely gutting their profitability. So they're not very profitable, but maybe investors are willing to pay a premium for that impressive growth. Let's check the price tag. We'll use the price to sales ratio. And think of it this way. For every $1 of revenue the company makes, how much are you, the investor, willing to pay for it? Well, for Webull, you're paying $5.90. Now, let's put that in context. For the average company in this industry, investors are only paying about $3.60. For Webull's direct competitors, it's just $1.50. You are paying a dangerously high premium, almost 4 times its peers, for growth that, as we just saw, isn't even making it to the bottom line. This valuation is stretched to the absolute breaking point. It assumes flawless execution and this massive future profitability that just simply isn't there yet. Now, let's move from valuation to the actual structural integrity of this company. It's time to bring out the heavy-duty diagnostic tools, and the first one is the Altman Z-score. For anyone who's not familiar, this isn't some obscure metric. It's a formula that was developed by NYU professor Edward Altman, and it's widely used by serious analysts to predict the likelihood of a company going bankrupt. Think of it as a financial health EKG. A score below 1.8 puts a company in what's called the distress zone, and that signals a high risk of financial trouble within the next 2 years. And what is Webull's score? It's 0.39. Let me say that again. 0.39. That isn't just in the distress zone, it is deep in the red. This is often caused by a really nasty combination of low profitability and high leverage on the balance sheet. It's a flashing, screaming warning light on the company's financial dashboard. According to this widely respected model, the company exhibits characteristics that are consistent with a very high degree of financial vulnerability. So forget the revenue growth for a second. This score questions the very stability of the entire enterprise. But believe it or not, it gets worse. If the Z-score tests for financial stability, our next tool, the Benesch M-score, tests for something else entirely: integrity. This is another academic model, this one developed by Professor Mesad Benesch, that uses a company's own financial data to calculate the probability that it has been manipulating its earnings. It's designed to look for anomalies and red flags in the numbers themselves. In short, it's a tool designed to ask one simple but very important question. Can we even trust the numbers we're being given? According to Guru Focus, Webull's Benish M-score is negative 0.65. A score like this indicates a strong likelihood of earnings manipulation. So let's just put this all together, shall we? We have a company that is missing profit targets, is trading at a completely ludicrous valuation, is flagged for high risk of financial distress, and is now flagged by a model designed to detect earnings manipulation. The entire bull case is built on the integrity of those spectacular growth numbers. And this M-score puts a giant question mark right on top of that foundation. These aren't just cracks in the armor, these are gaping holes.
Okay, those are serious, significant points. The Z-score and the M-score are absolutely not to be taken lightly. However, you have to remember these are backward-looking models. They're based on historical financial data. What they don't account for is the game-changing factor that could rewrite the entire equation for this company: technological innovation. The market is a forward-looking machine, and it might be pricing in something that these formulas just can't see. So let's talk about the AI wildcard.
So Webull just launched Vega, which is its proprietary AI-powered tool. And this isn't just another chatbot. This is being pitched as a decision partner for traders. It analyzes news, it analyzes earnings, market data, all in real time to provide personalized insights. The bull argument here is that Vega creates a durable competitive advantage, a real moat. If this tool is genuinely transformative and it helps their users make better decisions, well, it's going to attract more assets, it'll justify a premium service, and it will drive future profitability in a way that historical data just can't predict. This is how they can justify that valuation and grow their way out of those troubling financial scores. Or is it just another hole in the bucket? A shiny new feature that sounds great in a press release, but does absolutely nothing for the bottom line? Let's be real here. Every single company on Earth right now is slapping an AI label on something. The real question is this: is Vega AI a future profit center, or is it just another contributor to that 55% year-over-year increase in operating expenses we talked about? Building and maintaining a sophisticated AI is incredibly expensive. Right now, there is zero evidence that Vega is generating any kind of return on that investment. It could just be marketing fluff, an expensive gimmick designed to keep the growth narrative alive while the underlying financials just continue to deteriorate. That is a fair counterpoint. Is the AI an engine or is it an anchor? And that brings us to the final verdict. We've laid out both sides. You've got the explosive, undeniable growth story, and you've got the terrifying, serious financial warnings that are buried just beneath the surface. So it's time to put it all on the scales and deliver a clear, actionable verdict for the Iron Financial audience. No more debate, just the conclusion. Okay, let's run the final stress test one last time. Step 1, the bull case. The growth engine is absolutely roaring. Record revenue, record user assets, massive expansion. It's a powerful narrative, no doubt. Step 2, the bear case. The valuation is under extreme strain. You're paying nearly 6 times sales for a company that isn't even consistently profitable. Step 3, back to the bulls, the innovation edge. Vega AI and their aggressive global expansion could be the catalyst that drive future profitability and justify that premium. And step 4, what could be the knockout blow from the bears? The financial red flags. You simply cannot ignore an Altman Z-score of 0.39 and a Benish M-score that suggests earnings manipulation. These are not minor issues. They are foundational warnings about the health and integrity of the company. So our final verdict is this: Webull is a high-torque engine that has been bolted to a cracked frame. The power is undeniable, the growth is real, but the structural integrity of the entire vehicle is in serious, serious doubt. The risks are simply too great. The combination of a sky-high valuation and those deep red scores from the Altman Z and Benish models makes this completely uninvestable for a core portfolio. It's built for speculation, not for long-term investment. The potential for a catastrophic failure is just too high to ignore. You might win big, sure, but you could also get completely wiped out. And that's not forging a strong portfolio, that's just gambling. Which brings us to our final question for you. Webull's story really puts the entire fintech growth model right under the microscope. It proves that top-line growth alone is not enough. The foundation matters. So which of its competitors has actually built a stronger, more durable foundation? That's your homework. Do the same stress test on their peers. Look beyond the revenue and find the real strength. Thanks for watching Iron Financial. Hit that subscribe button and we'll see you next time for another deep dive analysis.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.